Pengana 6-monthly webinar for the Australian Equities Fund. My name is Damien Crowley. I head up Pengana's sales and marketing team. So welcome. Today, Rhett Kessler, who's sitting beside me, the Senior Fund Manager, will be providing an update on the fund. And I think given the recent market swings for the December quarter and the March quarter in particular, and given the reporting season obviously it's just finished, it's fairly timely to have this webinar. Rhett will speak for around 20 to 25 minutes, and then he'll go through the presentation deck. Maybe not all the deck. We'll just focus on some specific slides, which are fairly timely. We've given you a broader deck, so you get, depending on what your information needs are, you can use that deck obviously for conversations with clients as well, more broadly. Throughout the webinar, you can submit questions online, obviously, and we'll attempt to answer all those questions at the end of the webinar. And some of you have already submitted some questions, so we'll get to those as well. So I'll pass you over to Rhett, and thanks for joining us today. Thanks, Rhett.
All right, thank you, and welcome to everybody. Thank you for dialing in. As Damien said, I'll be speaking for 20 minutes and then answering questions. First and foremost, we're starting off with, I always like to just refresh what it is we're trying to achieve. And obviously, it's capital preservation and achieving a reasonable return. Now, if we look back over the 11-year track record of the firm, of the fund, I would point that in every single year until the most recent period, we have achieved our goals. No one is more aware than we are that we have not maintained the preservation of capital in the last 8 or 9 months. We're very optimistic that we'll still achieve that for the 12-month period, but we're cognizant of what's happened. And we have taken significant steps to ensure that we, A, we don't repeat this, and B, that we return to a positive situation as soon as possible. I have had quite a few questions from existing customers about longer-term track records. We understand that there's a dip in the last 12 months, and that has hurt our 5-year numbers. But as you can see from the 10-year track record, including the last 5 years starting 1 year back, we have maintained capital preservation and had pretty good numbers. If we flip to the next page, something we are constantly wrestling with, you've seen the slide before, is there's a time to be brave and there's a time to be disciplined. We think there's a bifurcation in the market happening as we speak, and I'm going to spend quite a bit of time talking about that and how we've configured the portfolio, maintained our discipline, and are positioned for the future. Nothing has changed in terms of our process. We still do not confuse investment risk with tracking error or business risk. We would love to, at times, take 10% of the portfolio and put it in BHP because that's the index weighting, BHP and Rio, and not worry about market movements in the resource stocks. But because we can't predict the iron ore prices or the oil prices, we don't do that. Similarly, we'd love to be in some of these tech stocks and ignore our discipline and valuation because they keep going up, but we will absolutely not do that. And I'll go into quite a bit of detail about why we haven't. I'm going to skip past our investment beliefs because I really want to deal with page 9, which is cash holdings. Currently, or more recently, we had about 23%, 24% in cash. I'm happy to say that for the first time in a little while, we have been very excited about some opportunities, and we've currently deployed about 4% of that 24% in cash in what we think are very attractive opportunities, and there's more to come. Now, if anyone gets excited, they are not in your tech stocks, they are not in your resources, they're in our typical toilet paper and toothpaste type businesses where we're finding opportunities. But remember that cash for us is not something we try to predetermine about how much cash we want to have. Usually when we've got high cash like we've had recently, it's because there's a paucity of opportunities. So just a very quick summary in 30 seconds about what we do. So first of all, just to recap, we have an idea generation process where we look under lots and lots and lots of rocks. we have seen tons of companies. We've been overseas, we've been domestic tours, and that continues unabated. Many companies are as confused as we are with some of the ratings of their own companies, and this includes the tech stocks, where almost to a man they all say, we don't understand why this kind of multiple has been attributed to our stock, but she will take it. Likewise, on the other end, stable, maybe a little bit boring companies feel that they're quite vulnerable to private equity takeout because they're very cheap. And we're navigating our way through that. Second is to assess the businesses. Yeah, we're looking for good businesses run by competent management at the right price. And then thirdly, it's our job to craft the portfolio, which I'll spend on a bit of time on in a little while. So we've got the investment process. We've included it in the presentation to facilitate any reviews you want to go through it. So nothing has changed in our investment process. And essentially what we're trying to do is find gifts that keep on giving. So if I can build a well-diversified portfolio of ever-growing annuity streams, I've achieved my task of helping you join us on the journey towards financial independence. And nothing has changed there. So what have we done in terms of performance? The performance numbers are sobering when we look at the December quarter. That was an awful quarter. We understand what's happened. We've done a fortune of work to work out what occurred. We think we fixed it. We've had some pretty sharp bounce backs. Admittedly, a lot of the market bounce back has been in resources and tech. We have not changed our discipline and chased returns, in spite of being uncomfortable to be left behind. The fruits of what we've done have started to play through, particularly in April, and particularly this month, where things have been sold off very, very sharply in the tech space and in some of the resource stocks. And we were making good money this month in spite of an environment where there are very, very soft returns, I would imagine, for others. Now, it's still very early days, I would grant you, but certainly there's a lot more rationality returning to the market, a lot more visibility. And for the first time in a while, we're getting quite excited about the opportunities that are presenting themselves as a result of these fast money flows. So what actually happened in those periods? And so what we've done is something a little bit different, where we've actually categorized our different sector concentration risks. And by that I mean we've taken, for an example, fleet management or fleet financing, and that's the color in, I think sorry, I'm a little bit colorblind, but I think that's the dark yellow color, where we've shown what has that sector done for us in the different quarters. And you can see that essentially there have been 4 sectors that have really hurt us, where we've had quite a bit of concentration. And so we've identified what's hurt us. Now, we know we've got one stock wrong, but in the other cases, we think it was more fund flows that impacted. Nevertheless, the sector concentration risk is something we've addressed. We didn't panic and sell wildly. What we did was we waited for rationality to return and then trimmed our holdings in those particular sectors. And if you go to the next slide, oops, just struggling to turn the page on my printer. We talk about the 3 main themes that we've done, that we've addressed. So first of all, and first and foremost, was to stabilize the portfolio volatility by reducing specific concentration risk. And I say in most instances into recent strength, because there was one in particular eclipse where our investment thesis broke down for various reasons, main one, management trust issue, and we sold out of that position. But in the other 3 higher above that, you can see that we had really good bounces in Viva Energy and Z, NRB and Medibank, Accent One and Flight Centre and Super Retail. And then there were others, including the banks after the Royal Commission, where we took advantage of much stronger prices to trim those concentration risks down. Secondly, as I've hinted at earlier, we've identified opportunities whilst absolutely maintaining our discipline and avoiding stretched technology multiples to establish some positions. Now, a long time ago, we used to have a position in Aristocrat. The stock fell a long way, and we managed to get a really nice position in that. We also were semi-traders in ResMed and Credit Corp, mainly because of the massive swings in their share prices. We're talking in excess of 20%. And there we sold significant amounts of stock into strength in both ResMed and Credit Corp. Both of them were individually. ResMed then fell 20%. We rebuilt a big position, and Credit Corp gifted us with a capital raising at a very deep discount and made substantial money. And then something a little bit unusual for us, we've done a lot of work on it. I'll answer any questions, but we've established a position in Dex's Office REIT at we think, a nice level due to a nice discounted capital raising. Thirdly, we are spending a lot more time focusing on our capital preservation toolkit. So our cash holdings, so that's a little out of date, it's now 20%. We've got significantly more non-Aussie dollar earnings exposure, which has helped us quite a bit. And we're spending a lot of time examining put options, which I'll talk about some of the not technicalities, some of the very pragmatic issues in doing that. In the following page, we're back to that color slide. I think what we've attempted to do here is to show how the concentration risks have changed, in particular in discretionary retail, fuel retailing, fleet finance and management, and diversified financials, and even waste management. So you can see there's been a more balancing of the portfolio. And if I can focus on one criticism of the portfolio management, the art, the third stage of our process, is that typically we're very, very careful about balancing the portfolio. And by that I mean is that, if you've got higher risk sectors, then you need to have lower risk sectors that are negatively correlated with the higher risk sectors. And we've always been very good at doing that. At the back end of last year, we had what I think is a unique set of circumstances at a time when we didn't own some of the utility stocks, and we didn't have as big of positions that we would have liked to have in some of the offshore earners, where the currency acts as a balance. That has now been fixed, and you can see it almost on a daily basis now in terms of the way the portfolio's volatility has come right down and quite positive in terms of the way it is generating positive returns. So that's a very useful slide, and happy to come back to their questions. Now, something that I've been hinting at and talking ever more strongly about is the bifurcation of valuations that we're finding. And in this slide, we've updated the multiples. If anything, it has become more extreme. There are more companies that we now have in the 500 plus or 100 multiple plus group. So we've truncated the y-axis to include those. And what I would put to you is that a 20 PE is already a stretched multiple on a 5% after-tax cash earnings yield if your reported earnings are equal to your cash earnings. Now, when you get up to 100 PE, I challenge anyone to tell me whether it should be on 130 times or 70 times. Those multiples are in nosebleed levels, and we think it's a momentum play, and we certainly will not be going there. I am going to relate one story of the Macquarie conference very recently, where while leaving a presentation, I was knocked over twice, or I was bumped twice, and then looked up to see roughly 1,000 people trying to get into the room, while I was trying to get out to listen to CSL's, one of their top value contributors, Gordon Naylor, do his final presentation because he's been in the company for 33 years and he was leaving. Key management team member always gives a great presentation for the third largest company, was happening next door. Only 24 other people joined me next door, while over 1,000 people try to cram into the room to listen to Afterpay. I've seen this movie before. Right? This is exaggerated focus by fund managers on particular sectors. So another quite sobering statistic, and some of you may have seen this before, but what we've done is we've taken all the stretch tech multiples, and we realized that when we added up the market cap, as a group, they are no longer trivial. This is a $65 billion group trading at an average multiple of 144, which is flattered by the fact that in getting to that 144 multiple, we've excluded them when they don't have earnings from the 144 average. So that's not being drawn down, taken up. It's actually it's a conservative multiple for this group. And if you haven't been in those stocks, like we haven't been in them, you've been left behind. Now, that does sound like an excuse, on my part, and I have to say that I think sticking to our discipline is the right way to approach this. But if I can just caution people, this is a stretched environment, and people should be concerned about placing money in this category. I guess finally, just in terms of why we don't have puts at the moment, is this bifurcation that's occurred. And this is just a simple bifurcation. So if you have a look at the multiples, you can see the impact of that 65 billion stratospheric multiple being reflected in the blue line, which is the industrial PE for the market, almost 22 times. Now, within that, there's a bifurcation where you've got your rational companies, the ones below the 20 PE that we show. But then also you've got resources and financials, particularly the banks, down at very low multiples. Now, with resources, we think it's because those earnings aren't sustainable. And with banks, that's got their own particular issues, which I'm happy to talk to if anybody's got some questions. But you can see that if you want to get puts on the all odds, you have to buy the whole basket, where resources and banks make up 60%. So accessing puts in this area is quite difficult at the moment because of the bifurcation in valuation multiples. But we will find a way to do it. We're busy working on it. I'm going to skip through the next two slides. I just thought they were very useful because we spoke about them last time. Essentially, the slide that's up now is where there's our investment theses have been validated, and there's a host of others that have occurred. The most recent is Flexi Group, which competes with Afterpay and Zip. It's a buy now, pay later type company. It makes $100 million, whereas the others make losses. It's on a PE of 4, where the others are on stratospheric multiples. And although it's been way behind, it's starting to catch up. And so although we've been in and we've been disappointed, the catch-up process of being up 25% yesterday and 10% today so now it's only on a 6 PE, is starting to indicate that there's some justification for underlying earnings that may or may not be sustained. I'm going to finish on this slide, which is essentially our top 10. We're quite transparent on it. As you can see, there hasn't been that much change in the top 10. Some of them are quite big and make up big parts of the index, and others make up, very, very small parts of the index. So we're completely index agnostic. I will highlight that our after-tax cash earnings yield is currently 7.3% for 2019. For 2020, it's quite a bit higher. And our non-Aussie dollar earnings is up quite sharply at about 13, 14% now. So maybe in summary, we've identified, I think, some of the issues, both self-inflicted, I'll take that on the chin, but mostly through a very unusual set of circumstances that we think we've navigated, we think we've adjusted to, but most importantly, we have not changed our process, we have not changed our discipline, and then finally, we think we're exceptionally well positioned going forward, and that's being demonstrated, although it's early days.